The Earned Income Tax Credit, or EITC, is one of the federal government's largest and most effective programs for supporting low to moderate income workers. Unlike standard tax deductions, which simply lower the amount of income subject to tax, the EITC is a fully refundable tax credit. This means that it can reduce your tax liability to zero, and any remaining credit amount is paid out directly to you as a refund. However, despite the significant value of this credit, the IRS estimates that taxpayers often fail to claim it every year, because they find the eligibility rules confusing or assume they do not qualify. In this guide, we will break down the rules for the EITC, explaining the income limits, dependency requirements, and the filing process. By the end of this video, you will know exactly how to determine if you qualify and how to claim this credit. To qualify for the EITC, you must meet several basic rules. First, you must have earned income. Earned income includes wages, salaries, tips, commissions, and net earnings from self-employment. It does not include passive earnings like interest, dividends, pension payments, Social Security benefits, or unemployment compensation. If you do not work during the tax year, you cannot claim the credit. Second, your investment income for the tax year must be below a specific limit, which is adjusted annually for inflation. For instance, this investment income limit is $11,000. If you sold stocks or received dividends exceeding this amount, you are immediately disqualified. Third, you must have a valid Social Security number for yourself, your spouse if filing jointly, and any qualifying child claimed on your return. Fourth, your filing status cannot be married filing separately, with a few exceptions for individuals who are separated and meet specific residency requirements. Finally, you must be a U.S. citizen or resident alien for the entire year. Once you meet these basic requirements, the credit value is determined by your earned income and the number of qualifying children you claim. The credit is designed to phase in as your earnings increase, reach a maximum plateau, and then phase out gradually as your earnings rise further, ensuring the benefit goes to those who need it most. The income limits for the EITC vary significantly based on your filing status and the number of children you claim. For example, a single filer with no children has a much lower earnings limit than a married couple filing jointly with 3 children. In general, having qualifying dependents dramatically increases both the maximum credit amount and the income ceiling, making the credit highly valuable for families. Let us look at the dependency rules and the specific value of the credit. If you claim the EITC with a qualifying child, that child must meet the relationship, age, residency, and joint return tests. The child must be your son, daughter, stepchild, foster child, sibling, or a descendant of any of them. The child must be under age 19 at the end of the year, or under age 24 if a full-time student, or any age if permanently and totally disabled. The child must also have lived with you in the United States for more than half of the year. If you do not have a qualifying child, you can still claim the credit, provided you meet additional criteria. You must be at least 25 years old but under age 65 at the end of the tax year, and you cannot be claimed as a dependent or a qualifying child on anyone else's tax return. The maximum credit values are substantial. For a filer with no children, the credit is worth up to $600. For a filer with one qualifying child, the credit rises to nearly $4,000. For 2 children, it reaches over $6,000, and for 3 or more qualifying children, the maximum credit is over $7,400. These amounts represent direct refunds that can be paid to you even if you had zero tax withheld from your paychecks, serving as a vital support. To verify these amounts, the IRS provides EITC tables annually. It is important to note that the earned income limits for a married couple with 3 children extend up to approximately $60,000, allowing many working families to qualify. Calculating your earnings against these tables is the key operational step. To claim the EITC, you must file a federal tax return, even if your income is below the filing threshold and you are not otherwise required to file. If you have qualifying children, you must complete and attach Schedule EIC to your Form 1040, detailing the children's names, Social Security numbers, birth years, and residency details. When you claim the EITC, you should be aware of the PATH Act regulations. The Protecting Americans from Tax Hikes Act requires the IRS to hold refunds for returns claiming the EITC or the additional child tax credit until mid-February. This hold allows the IRS to verify the income details reported on the return against the W-2 statement submitted by employers, helping to prevent identity theft and fraud. Therefore, if you claim this credit, you should expect a slight delay in receiving your refund. It is also essential to ensure your return is completely accurate. If the IRS audits your return and finds that you claimed the EITC in error due to reckless or intentional disregard of the rules, you can be banned from claiming the credit for 2 years. If the error was fraudulent, the ban extends to 10 years. In summary, claiming the EITC requires verifying your earned income, confirming your investment income, checking the dependency rules, and filing Form 1040 with Schedule EIC. While the rules are detailed, the financial benefit is substantial, making it well worth the effort to file correctly. To minimize errors, utilize the IRS EITC Assistant tool online before filing. This tool walks you through a series of questions to confirm your eligibility and estimate your credit value. Additionally, take advantage of free tax preparation services, such as the Volunteer Income Tax Assistance Program, which helps qualifying taxpayers complete their returns accurately. By utilizing these resources, keeping neat records, and filing early in the tax season, you can navigate the EITC process smoothly, ensuring you receive the refund you are legally owed without unnecessary delays. This structured approach helps you secure your benefits. To ensure you have a complete understanding, it is also helpful to look at how these concepts apply in everyday scenarios. Many professionals recommend documenting every step of the process, keeping organized records, and checking for updates to regional regulations at least once a year. By staying proactive and monitoring these changes, you can adapt your approach, avoid common pitfalls, and make more informed decisions that align with your long-term objectives and protect your household budget from unexpected expenses. Tax Season School explains tax rules, tax documents, and simple filing habits in plain English. The channel covers W-2 basics, freelance filing, deductions, HSA rules, and common mistakes so viewers can stay organized and make informed decisions with their money. This video is general financial education, not professional tax, accounting, legal, or investment advice. Tax rules change frequently and vary by location and situation. Consult a certified public accountant or tax professional before making tax decisions.